three.
Good morning.
Good morning.
How is everybody at the wonderful conference? This is the NACVA, Around the Valuation World, the second day of our conference. That's the Around the Valuation World for the early risers. I thank you all for being here. I'm Greg Caruso. I am the editor-in-chief. For that, I get to do a lot of work. I also value businesses and do a lot of business brokerage. Stephen White is here with me today. Besides dressing better, he also does litigation and higher-end valuations of all types. And we're very pleased to have Roger Gabrowski with us this morning. It's quite an honor to have him up here and to know we woke him up too. So
thank you.
Would you like to, I guess you don't really need an introduction. Everybody knows you and what you do. So why don't we just dive in as we have fairly limited time this morning. I know Duff & Phelps took over the cost of capital book. Was it 3 years ago now?
2014 was the first edition that we put out.
Well, time is crunching for me. And you took the book and within a couple of years, you've converted it to a database computer program. Why don't you talk about why you did that and how that's working?
Okay, well, let me give you a little background. In September 2013, Morningstar announced that it was going to stop publishing various valuation books. It had decided that that was not consistent with their other businesses. So we at Duff & Phelps were a user of Morningstar data published in the Ibbotson Valuation Edition yearbooks. And we had been publishing the risk premium report data, which I started developing in the early 2000s and had published actually on Roger Ibbotson's website for a number of years. So the question was, how were we going to respond? Not because we wanted to go into the book publishing business, but because our people use the data. So we were already a licensee of the Center for Research on Security Price Data in order to do the risk premium report. So we had a relationship there. Jim Harrington, who had been the editor of the Valuation Edition and other Morningstar Ibbotson books, had joined me several years earlier, and we sat down and said, okay, how can we fill the gap for our own people and hopefully help others? So we decided, and this was not a long thought out process. I stuck my neck out and I told the powers to be at Duff & Phelps, we're going to publish a book. And the reason we chose to do that was not that we had planned a long time to publish a book. It simply was expedient. We got nothing from Morningstar. We weren't provided anything from Morningstar, including nothing about who had ever bought their book. So what we did was, because I had been co-author of the Cost of Capital 5th edition, we were able to borrow text from the Cost of Capital book. We were able to assemble text. We went to CRISP, licensed the data. We had a good relationship and continue to have a good relationship with CRISP. And we were able to put this together, and we viewed it initially as sort of a stopgap. That is, just to get over the fact that we had this short window from September 2013 until the data needed to be distributed in February of 2014. So we put together the book. Mm-hmm. We published that book, self-published the first year. For 3 years, Wiley publish the book and distribute it. And then we ended our relationship with Wiley and went back to self-publishing. During that year, when we self-published, we actually did what we probably would have done back in 2013, 2014, had we had more time, thinking about what is a new age way of delivering information.
Right.
And so you think about when I started doing valuations, we did analysis on 14-column working paper, okay? Now you use Excel. So we wanted to take data out of the 14-column working paper environment and put it in the environment equivalent to giving you tools for Excel. So we decided after a year of self-publishing the book, we decided that for a number of reasons. First of all, we found it very difficult to deliver a book in a timely fashion, because to get a book published, all of the material has to be assembled before you go to press. If you're doing it online, you can publish the data, you can publish sections of the material as the material is available. So it takes a great burden off of us as deliverers of data, because the data is a timely product. That is, you want the data as soon as it's available. Most books, for example, the 5th edition of The Cost of Capital, we used examples from data that were 2 years earlier. So that wasn't going to work, the normal publishing, and it became a burden. So we decided for a couple of reasons. First, it was easier for us. Secondly, we have an inventory of ideas of new data that we want to provide. And in a book form, there's just too much, there's too many pages then, and people get lost and they really don't take advantage of it. Third, we found people not using the data correctly. And how do I know that? Is I do litigation work, and we would review other people's products, other people's reports, and they were misusing the data. So we put together a guide of how to implement the data through going through the steps. It is not a black box. I use it in litigation. It can't be a black box. So every step is printable. Every step is auditable. All the data is there. We're going to be adding, it gives us the facility of being able to add both reference material, that's background material, as well as the potential of adding new data sets.
Well, it's truly a game changer what you're doing in the valuation space. So you go from the hardback books. What's next? What do you have on the agenda now?
Well, there's a couple of things. I hate to use the term artificial intelligence, but what we're going to do is improve the user experience. Now, for those of you like myself who have been doing this for a long time, you sort of know when you look at the raw data, whether you want to test something else. You have a sense of this. But to hand down this profession to the younger generation, we hire people who certainly don't have the level of experience we do. How do we sort of stand over them and point, have you considered this? Have you considered this? Have you considered this? In the process of delivering the data. So what we want to do is offer a more interactive experience with the user,
Okay.
so that the casual user, and that's the person who does 3 valuations a year,
Mhm.
you don't remember necessarily all the nuances if you put down everything and you come back to it 6 months later. And clearly the young staff that you have working for you doesn't understand all the nuances. So since I taught the cost of capital seminars for a number of years, and in those seminars, we did this sort of interactive, how do you look at data? How do you look at alternatives? How do you test your data, et cetera? We want to take from just a data delivery to being a teaching tool so that it can help with the casual user or the novice user. And let's take, for example, the corporate area as an example. Here we're dealing with people that are at least doing some valuations regularly. In the corporate world, they have to figure out the cost of capital. And one of the things that I've discovered about the corporate world is there is a lot of turnover. And so all of a sudden, someone gets shifted from one department to being in charge of coming up with the corporate cost of capital. All they know is what they may have learned 10 years earlier in their MBA class. How can I facilitate that person understanding the data, understanding how to match risk and return? I have to teach them and remind them the nuances. Everyone who had a class, some of us remembering years ago, it's like watching black and white television. Everything was simplified. We know the world is not simple. So how do you take the simplified world and teach them what they should be looking at and doing comparisons? Another thing we're going to be doing is integrating. We publish a data about industry cost of capital. So we've started integrating the industry cost of capital data with the base size premium, equity risk premium data, so that there's comparisons, so that people automatically get, well, look at what the industry cost of capital is for small companies in this industry. How does your calculation compare? And it's sort of helping sort of bridge. We have 4 books. We want to integrate those 4 books, or at least the US-centric books, the 2 of them, and the 2 international books, in a deliverable that's integrated so that people get the most out of the experience.
All right.
Fantastic. In the meantime, until we get to that the next edition, the next version, for the practitioner that does do 3 a year, I know one of the comments we've gotten recently on our show from a couple people was, it used to be so simple, and now it's not. What should I do? You seem like the perfect person to ask that question to.
When I started in this business, and all I had was the Ibbotson data, I used the back page just like most people did, and for size premia, not knowing much. And then I was in a court case, and an academic who I respect very much challenged the whole concept of size premia, because the data was measuring size by market value. They said, how do you know that those companies with small market value are really small companies? Couldn't they be companies that are just in trouble? That is, a company whose debt has gotten so big that the equity has been bid down. So a colleague of mine at the time, Dave King, and I, we started investigating, was size based on fundamental measures, total assets, net income, sales, was the market recognizing that the difference in company size based on fundamentals gave you different returns. We started publishing the risk premium report data. We've been publishing that for more than 20 years now. It is designed for the small practitioner who doesn't know what the market value is, who knows when he goes that it's a small company because it's obvious. You look at the balance sheet, you look at the income statement. So you can match the fundamental characteristics to the data in the risk premium report. And we provide an extrapolation of the data for the companies so that you can use a regression analysis to extrapolate if in fact the company is smaller than this group of public companies, that you can feel comfortable that I'm getting a reasonable estimate of the rate of return for a small company. So these are tools that I started working on, as I said, 20 years ago and improved since then, because I do small businesses too. The other thing that we provide in the resource section in the Navigator, Cost of Capital Navigator, is a display of the companies that make up our 25th portfolio so that you can see, are there only big companies? Are there some small companies? And you can see what their profit margin is, et cetera, so that you can do the best job you can of what we are responsible for, and that's matching. Our whole job here is to match the characteristics of a subject company to the characteristics of the data from which you're drawing the risk premiums. And so we provide that underlying tie to what makes up that data. And now we do it for several of the portfolios. We publish 25 portfolios, but people always ask, well, what about the 26th and 27th portfolio? Sure. That's the extrapolation through the regression. But if you look at the data about the 25th portfolio, you will find that there are many small companies in there, smaller than you think there are. We have this idea that public companies are all huge, and that's not the case. There are small public companies because we're pulling data off of NASDAQ, not just the New York Stock Exchange.
Fantastic. Well, thank you so much for being here this morning. We really appreciate it. Do you have any final thoughts or?
Yes, I very much appreciate the opportunity to be here and to be with you. And your inputs are very valuable to us at Duff & Phelps in terms of being able to produce the product and the tools and in a way that is, we're all in this together, right. Okay? And that's really the philosophy that we try to do.
Again, thank you so much.
Okay.
It's a pleasure having you.
Thank you, Steve. Thank you.
And now we'll just
head
over there. If the correspondents that are here this morning could come on up. Thank you so much, Roger. So yesterday, I know it must have been a good show because I got a lot of comments about my socks. So I calmed them down a little today. I'll let you know. And I guess for those of you who have attended our morning show again, you know what's next. We changed the format a little bit in prior years, we've run around and done these videos as opposed to seeing the next session. So we've tried doing some of the videos a little bit in advance, so we'll see how that goes. And of course, our correspondents did make the sessions, and we'll have a little discussion between them. So if we can start, our first video is was the presentation Managing Business Interruption Claims by Joe Epps and Carrie Merrifield. Let's roll the tape. I guess it's not tape anymore, but hey.
We'll still call it tape.
Yeah, that's it. I still have a Rolodex. That really dates you. We think we're rolling the tape.
There we go.
Hi, I'm Melissa Gregg, and I'm here to interview Carrie Merrifield. She is providing an overview of business interruption calculations, the rest of the story. That's pretty interesting, Carrie. Can you maybe give us a little bit more about your background and the company you work for?
Yes, I've been doing litigation support, French accounting, business interruption claims for about 15 years now. I've been in the accounting industry for about 30. I've testified probably over 50 times in different matters. I work in the California area and I'm opening actually a new office in the Texas region. And I focus on any kind of calculations that have to do with any kind of litigation. With business interruption claims becoming a more and more prominent type of claim in the modern day with all the fires, the floods, the earthquakes, and tornadoes. This is really becoming a really big industry for anybody that does this type of work.
Now, in your presentation, for anybody who may have missed it, what are your two main takeaways from the presentation?
I say the two main takeaways would be, first of all, do not represent the client directly. You need to work with either a public adjuster or an attorney. That would be the most important thing. The second most important thing I would say is read the policy, the business interruption loss policy, and understand what it says, because each one is going to be different. You're going to have to know that policy very well. Those would be the two most important things that I would say would be the takeaways from that.
And your presentation goes through a couple different ways of calculating business interruption calculations. But do you have a really interesting story about a client that you've worked with that kind of had a twist in the scenario?
Well, there was actually one client that actually was a really interesting case. It was up in Hollywood. She had a storage facility and she stored a lot of the movie props and a lot of artwork or collectibles for people with a lot of money. And where she had it stored, she had complained about leaks, a little bit of leak in the corner, to the owner of the building several times. And they did not do anything to repair this issue. Then all of a sudden one day she came in and everything was flooded. So everything that was on the ground was actually destroyed. And these are really valuable items. So not only did the items get destroyed, it was her reputation as well. So there was a business interruption claim, which was a very large one on that one. But it was interesting because, the people involved, what was involved in learning the value of these items and who actually was responsible, and then how long it took her to actually, we talk about a ramp up period in our thing, but how long it took her to actually reestablish herself in the industry.
Oh, that's great. That's very interesting. Well, if people have any other questions, I'm sure they can reach out to you or they can get a copy of the presentation. Thanks so much for the interview.
Definitely. Thank you, Melissa.
Well, there you go.
There you go. So I think that business interruption claims are a little bit of a nuanced segment of a line of work that we can do. And I really don't think any time that you can learn everything that you need to know in a 2-hour session. There is, I had the benefit of going through the there's a 4-part training on business interruption claims that they actually provided maybe a month ago. And I think it's probably available on CPE on demand through the NACVA. But one of the slides that I thought was really helpful and supplement to yesterday's presentation were some notes to the expert. And I also sat in on a session yesterday about the psychological effects of decision making. And they talked about identifying the problem. And most people kind of gloss over that and don't really identify the problem. Well, in business interruption claims, it's the same type of situation. You really have to start with what does the insurance cover? So you not only have the interruption happening, but what is covered, and really going into that, because that's going to limit any type of amount that they're going to be able to recover. But a couple notes that they had was initially reviewing the policy and understanding the terms, understanding the covered causes of loss, determining the time frame, understanding what the POR is. Anybody watch that yesterday? So the period of restoration, these are, again, I think important terms that you have to understand, or else you're going to say, oh, I could do a business interruption claim, and you're going to get involved and somebody's going to say a term like that to you and you're going to be like, POR, I don't know. So if you want additional training, I think it's available, and you can get, there's a ton of business in that space.
Thanks. Right. POR, just like REO, but we won't go into that one. He got it. So let's move on to our next clip. We have How to Reconcile Significant Differing Expert Opinions with Mallory Ashbrook and Rebecca Smith.
Hello, good morning. Very early morning at that. I am here with Mallory Ashbrook and Rebecca Smith, and they just gave the presentation, How to Reconcile Significant Differing Expert Opinions. Really good. It was exciting. Let me ask you two, what will participants take away from this presentation, from the attendees and people who watch the tapes?
Well, thank you, and good morning, everyone. We put this presentation together because we were getting expert reports from good qualified experts that we would look at the reports and think, are we even working on the same case as these folks? And what it came down to is we realized there's a couple of fundamental places that experts can diverge, and just in big, broad categories. What we talked about yesterday was that it could be you were asked to look at a different measure of damages, or that you and the other expert have different documents and access to information because of who your clients are or what's been produced, that you've been asked to make key assumptions, or that you've developed different key assumptions than the other expert. And so we went through that in great detail yesterday with a lot of really relevant live examples. We used some actual cases that we had encountered and took the participants through those examples and showed them how to spot the issues, and then how to potentially correct for those issues in yourself, or how to be persuasive in convincing the other expert that perhaps they were wrong as it relates to those issues.
Fantastic. That is great. So let's sort of shift gears. As a newbie, what would I want to know? What will I get from your presentation?
So I think that the biggest takeaway for newbies from this presentation is it's also okay to have different expert opinions. You're in litigation, and the point is that the parties aren't agreeing on things, which means you're ultimately going to end up at a different damage number. Ultimately, it comes down to the money, and that's probably what they're disagreeing over in the first place. So if you get another expert report and their number is way off from yours, don't panic. It's okay. There's different legal theories. There's all kinds of different things that go in that make it okay to have a different opinion.
Absolutely.
Wonderful. So we can all, we start where we start, and then at least a part of the real work begins. All right. Shifting one more time, as a experienced practitioner now, what am I likely to have forgotten or maybe not be applying like I did as a beginner?
Yeah, so the one thing that we talked about that is, I think, really interesting is talking about implicit bias. It's kind of a soft word out there, but we talk about how implicit bias can impact how you approach a case and things like confirmation bias. And I think that's really easy to forget, that you have these biases that you have to be aware of and address as you get experienced and comfortable.
That absolutely. Well, listen, it was a great presentation. We appreciate your work for doing it and for doing this. And I really want to thank you, Rebecca and Mallory. Thank you very much for this.
Thank you.
Greg and I had the opportunity to attend that session. I would say for me, I do not work in this area. It was fun, it was educational, and I really enjoyed the session. And what were some of my takeaways, and also picking up on what they just had to say in the video? First of all, the attorneys are going to come forward with their theory. That's their theory. As a valuer in this area, you're not doing a business valuation. Rather, you're developing a methodology that is a but for. That is, but for the event that took place, what would it take to make that party whole? They ran through, and you just heard two of the elements relative to bias, but they started off with intentional bias that the other party may have. Then they moved into implicit and then into confirmation bias. Those are all things to consider. In the end, you have to address Rule 702. You're there to help the court. And sometimes when you work with the court, you can obtain the data you need. It's not an issue. Other times that can be tough. And sometimes the court will say, just do it. And if you just have to do it, you have to make assumptions. So it's very important that you ground those assumptions in something relative to the facts. And then finally, they said, as you work through this process, go back and do a sensitivity analysis on what you did and attempt to do a sensitivity analysis on what the other party did. Where are the most significant elements you want to bring to your attorney for them to consider as they're pursuing this case? I also want to make a little plug, and that's for today. Roy Salter is going to be talking about how to reconcile differences as well, but he's going to address that relative to the theory and an application of he's worked on his dissertation relative to this topic. And I just want to plug that for today's session. You might very well enjoy that and hear what the highlights are for that for tomorrow.
Thank you, Michael. So I just realized also as I'm sitting here, I forgot to introduce our fine correspondents. Just come on up and get to work. So anyone who watches the show, I'm sure knows them, but Milos Grag, who does a great deal of litigation and is certainly my resource when I make the mistake of taking a valuation that might be used in litigation. Ed Mofrad, who does a variety of things, has done international work, worked for the IRS, and does both valuations, tax work, and he is a true jack of all trades. And of course, Michael Gregory, who we all know for IRS work, and then he's also very involved in mediation and dispute resolution type matters. So now that I actually had some manners and introduced the wonderful people I get to work with, we will move on to the next presentation, which is Business Valuation, an Operational Perspective. I'm from Jeff Harwell.
Hello, this is Ed Mofrad of Mofrad Financial Solutions of Los Angeles. Today I have the pleasure of interviewing Mr. Jeff Harwell of Fort Worth, Texas. His practice is called Harwell & Company. They do business and forensic valuations along with machinery and equipment valuation. Mr. Harwell has been at it since 1975, on his own since 1981. Wonderful presentation yesterday, Jeff. I enjoyed it. I benefited from it. I have a couple questions. Why do you feel it's important for an operations perspective to be had by your colleagues?
Thank you, Ed. In short, I think it's critical that as valuation analysts, we speak the same language as our clients. And that's reflected in our reports. We've got to have credibility, and without speaking the same language, and I mean the interests of the clients and the drivers of the business and how we reach the conclusion of value with the clients. If we don't do that, we don't have credibility. So it's imperative we speak that language, and that's from an operational perspective, not just a financial perspective.
Got it. And for some of you less experienced colleagues out there, what might be the solution to some of the same issues they're facing?
Well, I think the simplest solution is we need to do our homework ahead of time. In other words, we need to do some research on the industry pre-engagement. We need to do some research on the industry and the business before the site visit, so we have the right questions to ask, the probing questions to see what it is about the business that makes it unique, what's of interest, the shortcomings for the client. These are all questions, and if we don't have a perspective of that industry or business, we have to do the research.
Any additional benefits?
Certainly. Once you've done your research and you hit all the elements that are operational, that are of interest to your client, and they're documented in the valuation in terms of how they impact, you're certainly going to get more referrals from the client. You're going to have an increased credibility with the client and other people within the community. And
very important indeed. Absolutely. It's been a pleasure. It was very beneficial for me to personally listen to you, and thank you.
Thank you, Ed.
If I could summarize Jeff in one word, that would be value. In the course of interviewing him in this past several days and getting to know him, I really earned respect for the man. He's the kind of person that would actually turn down lucrative projects because he feels, somebody else can best serve them, and he would actually refer the case to somebody else. His theme is all about operations, details, nitty-gritty details. He feels that by paying attention to the details, the outcome is going to shine and the value will speak for itself. He has many years of experience. He's the kind of person that I would go to for operational and machinery and equipment details again, and technicalities, and he gives of himself freely. Again, I've known him to give business to other people, to attorneys, to other evaluators, to accountants, because he truly sees the best interest of the clients, and that's the foremost in his mind. So it was a beneficial learning experience for me as well.
Well, thank you. And I do think that's one of the points of coming to these conferences is we can all get so much from each other and so much working together. I know I've learned more from people at this conference, and particularly afterwards when I do get stuck. So thank you for that.
One more thing, he made a concluding comment that I would like to quote here. He said, "Details matter, they create depth, and depth creates authenticity." So that's that's Jeff in a sentence.
Thank you. So we have one last clip that we like to share, and this one is examining the numerator in the valuation equation by Jem Alden. And actually, I was the interviewer. So we'll flip to this video clip. Good afternoon, everyone. I'm Stephen White, and I'm here with Jem Alden, former member of the AICPA BV Committee and an inductee into the AICPA Business Valuation Hall of Fame. He has been co-author on a number of different books, and I have the distinct pleasure of being here today to interview him to talk about his presentation that he will be delivering at the 2019 Annual Consulting Conference in Salt Lake City. Jem, how are you this morning?
Very good, Stephen. Thank you very much.
Good. Now, the topic of your discussion is examining the numerator in the valuation equation, forecast, and projections. Now, I find that topic to be very fascinating, but what triggered in your mind that you thought that this was a timely topic to discuss at this year's conference?
Well, I've been kind of ruminating over this for the past several years, where I think it's just my own personal opinion that the whole valuation process, particularly under the income approach, is, I think, becoming too complex and maybe too much of a black box. And I wrote another article that was published not long ago on a couple of newsletters about, have we missed the forest for the trees? And the concept there was, let's not get too far afield on the cost of capital, and let's not beat it up for too long a time. Let's look at the top line, which is the income line. And I think too many people spend too little time on the income part of it, on that equation, I over R equals value, R being the rate of return, I being the income stream.
Sure. Now, going through this overall presentation, I noticed a couple of sightings that you have in there. Walk us through that process of why you chose the professor from NYU to be a part of this.
Well, yeah, Dr. Demoter and I know, we kind of know who each other are. He's been very helpful to me in this way. And what he did is allowed me to use some of his information, because he feels very strongly also that the income side of this cannot be ignored when you're putting together a valuation concept. His offline comment to me, which is not in the slides, was, good luck getting everybody to pay attention. But so that's what I'm trying to do, is get everybody to pay attention to it. And in addition to him, I've also used sources that are out there for helping valuation experts to do this kind of work. And I think that it's an entertaining and I hope a very helpful presentation.
Well, I think everyone will enjoy this presentation. We look forward to hearing you at the conference. Thank you, Jem.
Thank you very much, Stephen.
Well, for those of you who were able to attend his session yesterday, I think you all walked away amazed, because he is a fantastic speaker. He's a wealth of knowledge, as everyone knows, and he's a great resource to be a part of. I think when I sat there and I had the interview with him, discussing a numerator as a valuation practitioner and doing just valuation, it is something that makes you think about a little more. And going through his presentation, unfortunately, he had to cut it short. If you did not have an opportunity to attend his session, I strongly recommend to download his presentation off of the app that we have. It's very easy to go into, download it, and review it. His contact information is there. He wanted me to make sure that I shared it. He is available to walk through some of the slides, the illustration that he has, because I think it is one of those types of things that you really should take the time to really have an understanding of, especially when you're dealing with more of the small businesses.
Fantastic. So that wraps our video presentations. What I would like to do is put a plug for our show. Yes, Greg, the business broker, comes out with our monthly show. It's typically the third Monday of the month, 1 o'clock Eastern time. You'll have to work yourself back if you're on the West Coast. It's a 2-hour show. It's different, but kind of similar to what you saw here today. We do try to cover a variety of topics. We have guest speakers. We have short educational pieces. Michael Gregory does a summary of some of the more current topics. So it is a good way to stay with what's going on. If you have plenty of continuing education from other locations, from other things you do, I know some of us might, it's free. If you want the continuing education, there is a charge. I don't remember the amount. It's fairly reasonable. I will also say there is a 25% discount for that fee. I think it's in the $200 range, whatever it is. There's a 25% discount related to the conference. I think usually they keep it open for a week or two after. So if this is something you would like to be a part of, and we would love for you to be a part of it with us, now would be a good time if you do need the credits. I want to thank you all. Oh, sure. I'm sorry.
30 seconds.
No.
So I got a
Perfect.
couple responses yesterday about, I guess, my last comment on yesterday's show. when I said how you can train people. So I got some comments that they sent back and they're like, okay, but how do we do it? So like for 30 seconds, I'll tell you real quick, there's 2 ways that I think are really easy. One, I use GoToMeeting, and I basically have a meeting with no one, okay? So I launch it, I share my screen. I usually have the person there because it's easier. Like if you're training somebody, it's easier to kind of train them. And then it records and then I press the record button, it records my voice, it records the screen. We walk through spreadsheets or, how to download data and things like that, and it captures it all. And then I load it up onto a private video in YouTube so that it has a private link. And then we just have a sheet, like a training handbook, if you will, that has all the links to those videos for different subjects. There's also a program called Camtasia, Camtasia, I believe. And it's a screen capture program. And so, I don't know. I think that's actually maybe $100 and you never have to pay for it again. And then GoToMeeting, I don't know. There's different versions. So those are the 2 ways that I do it. Maybe other people had questions and I really don't want to get like 200 emails about it. So those are some of the easy ways to do it. So I thought I'd address it here.
Yeah, I'm actually, well, I didn't have the sense to think about it for training. We're actually starting to do some similar things. I just got my slide deck finally for actually our bringing our customers in process, sort of, when they want to know how do you do it? What's the process? We're actually starting to record a little quicker version of the slideshow so that, again, some of our clients who, when we get busy, or if they're coming through the web process, they can learn parts of how working with us is going to be.
Part of all the marketing people, it used to be content creation, but now it's documentation. So it's documenting your process. It's documenting your sales process, your intake process, your everything. If you can record it in some capacity the right way, because you're the main business, like you're the main valuator. If you can record it in any capacity, it's going to be super helpful for either your clients or your team, or your referral sources, anything. So documentation is kind of the big keyword right now in marketing.
Yep. Well, I'm not so sure about that. We're still trying to do what they were telling us 3 years ago, but we're getting closer to it. I don't know what your sensation was, but watching myself on that screen, I felt like I was watching a cartoon character. So I hope you all enjoyed our show this morning. Tomorrow morning, Melissa Gregg is going to be running the show because I am going to be at a family wedding, and I know it will be an excellent show. I believe Stephen and Ed are going to still be at the conference, hopefully with a good number of you. Please come back, watch the show. Watch us tune in again on the 3rd Monday of the month. And we do appreciate your listening, all your work. Your comments and feedback are greatly appreciated. And enjoy the show. Thank you.